Para la cuarta sesión, Experiencias en productos de jubilación, un análisis de los productos para la jubilación, dadas las necesidades cambiantes de la población y la nueva realidad demográfica de los países. Para esta sesión tendremos de moderador al señor Helio Sánchez, superintendente adjunto de la Superintendencia de Banca, Seguros y Administradora de Fondos de Pensiones del Perú. Don Helio, adelante.
Muchas gracias y muy buenas tardes con todos. Gracias también por estar acá en esta última sesión, no por ello la menos importante. Es una de las sesiones quizás claves de este evento que, como mencioné en la mañana, ha sido organizado de tal manera que aborda puntos muy importantes para nuestros sistemas de pensiones. Esta sesión 4 se denomina Experiencias en productos de jubilación, en donde el objetivo va a ser analizar los productos para la jubilación, dadas las necesidades cambiantes que tiene la población, los trabajadores y, por supuesto, adaptarse a la nueva realidad demográfica de los países, más que de los sistemas de pensiones. Para ello, contamos con un panel muy selecto, que va a abordar, digamos, los temas de diferentes ópticas, pero yendo, insisto, al objetivo común. Esta fase, que es la fase de desacumulación, viene a representar, digamos, la parte final del periodo de acumulación, no solo de esta sesión, sino la parte final del proceso de acumulación y de inversiones, viene a cumplir o a tratar de llegar a que los trabajadores puedan estar debidamente protegidos y poder afrontar los riesgos que implica la vejez, por supuesto no caer en pobreza, y afrontar la longevidad y los otros riesgos que tienen que enfrentar los trabajadores al momento de retirarse o jubilarse, y por supuesto a las personas ya en edad avanzada para retirarse. Voy a dar inicio con el primer panelista, que es la señorita Ana María Brenes. Ella es gerente general de BAC Pensiones, que es una operadora y, por supuesto, entidad supervisada por la SUPEN, que además entiendo que es un operador importante en el mercado, con presencia también importante, vale la redundancia, en el pilar voluntario. La señorita Brenes cuenta con una maestría en Economía en la Universidad de Costa Rica y en Administración Ejecutiva de Empresas del INCAE, además de tener una licenciatura en Administración en la Universidad de Costa Rica. Ella nos hará una presentación acerca de la situación actual del sistema de pensiones de Costa Rica y los desafíos que enfrenta este sistema en el proceso que vamos a tratar en esta cuarta sesión. Por favor.
Buenas tardes a todos. Muchas gracias a SUPEN por la invitación. La verdad es un honor para mí estar aquí compartiendo con ustedes algunas de estas ideas en el 25 aniversario de esta reforma tan visionaria que se implementó. Debo reconocer que cuando me invitaron a hablar justo de los productos para la etapa de retiro, pensé que la suerte no estaba conmigo, porque la verdad es que es una etapa para la cual lo que tenemos hoy día es una solución parcial. Y ahora les voy a elaborar un poquito por qué. Sin embargo, luego pensé que es una gran oportunidad también para aprender de representantes que dichosamente tenemos acá, de otros países cuyos sistemas van más adelante que el nuestro, y podemos aprender para desarrollar una solución que sea más conveniente para nuestros afiliados. Porque este es un tema importante a abordar. Y recordando que lo que estamos celebrando son apenas 25 años del sistema multipilar, este es un punto en el que todavía no podemos esperar que las pensiones sean muy altas o que la tasa de reemplazo haya alcanzado lo que se espera todavía en su totalidad del segundo pilar. En diciembre del 2024, apenas el 2% de los afiliados estaban pensionados. Esto es apenas un poquito más de 75,000 personas de 3 millones de afiliados que tenemos. Sin embargo, en los próximos 20 años, este porcentaje va a estar cerca del 40%. cerca del 40% de los afiliados al sistema actual se habrán pensionado en el transcurso de los próximos 20 años. Y esto hace que poder tener una solución más conveniente para ellos sea un tema apremiante. El retiro total del ROP fue una alternativa durante los primeros 10 años del sistema, cuando todavía el monto acumulado no permitía tener un monto más alto o conveniente de pensión. Hoy día está disponible solo bajo algunas excepciones, por ejemplo, casos de enfermedad terminal, lo cual protege a las personas afiliadas de gastar de forma prematura esos recursos acumulados y quedar en una situación económica vulnerable. Hay algunas alternativas de retiro acelerado que están disponibles para personas que se pensionaron entre el año 2020 y 2030. Sin embargo, esto está disponible en la medida en que todavía las pensiones no habrán alcanzado su potencial total. Dejando esas alternativas a un lado, lo que ofrecemos hoy día para los afiliados son principalmente dos opciones. Que consisten en la renta permanente, cuyo propósito principal es preservar el que sería el monto principal al hacer una distribución mensual de los rendimientos que se han acumulado en los últimos 36 meses. La otra alternativa que ofrecemos a nuestros afiliados es el retiro programado, cuyo objetivo es maximizar el consumo, y el cálculo del monto mensual se hace una vez, se actualiza una vez al año utilizando los retornos esperados y la expectativa de vida actuarial. Sin embargo, y como podemos ver en la pantalla, esto expone a los afiliados a una volatilidad importante en su etapa de retiro, en el ingreso, en la pensión mensual que reciben. Podemos ver que entre el año 2020 y 2021, la pensión mensual que se pagó a los afiliados al ROP tuvo un incremento del 10% en tan solo un año, y al año siguiente ese monto disminuyó un 27%. Al año siguiente disminuyó otro 3% para recuperarse un 14% al año siguiente, lo cual representa una volatilidad importante de un año a otro en la pensión mensual que están recibiendo estas personas. Este cálculo está bastante influenciado por el uso de la modalidad de retiro de renta permanente, cuyo cálculo está asociado a la volatilidad que se presenta en los retornos del mercado, dependiendo de las condiciones que se estén presentando. Sin embargo, la otra alternativa, la del retiro programado, al hacerse un cálculo también, actualizarse de forma anual, también expone a los afiliados a una volatilidad importante. Como lo podemos ver, y que se supone que es la modalidad que debería de ser más estable o que permite a los afiliados mitigar en alguna medida el riesgo de longevidad al tomar en cuenta la expectativa de vida, vemos que también presenta un nivel de volatilidad importante, niveles superiores a 10% de variación de un año a otro en el monto de la mensualidad que están recibiendo las personas. Esto, otra consideración importante es que la población general quizá no está tan familiarizada con la volatilidad que se presenta en los mercados. El mercado de valores nuestro predomina la negociación de la deuda pública. Y es un mercado donde no hay mercado de capitales, no tenemos un mercado accionario, de forma tal que esto de la volatilidad en los rendimientos financieros no es algo con lo que las personas estén tan familiarizadas. Entonces tenemos ahí un elemento también de educación financiera que constituye un desafío para quienes gestionamos las pensiones. Aunque la regulación prevé la posibilidad de que existan las anualidades, no están presentes hoy día, no está desarrollado en el mercado. No tenemos ese producto actualmente disponible para nuestros afiliados, que quizás sería el que ofrecería el ingreso más estable y que mitigaría el riesgo de longevidad. De tal manera que tenemos aquí dos necesidades principales, siendo preservar el ingreso mensual que reciben los afiliados del ROP, considerando que del régimen básico, y como lo hemos, se ha comentado en presentaciones anteriores, presenta el desafío asociado a la evolución demográfica. Entonces, proteger los recursos del ROP para que puedan seguir constituyendo este ingreso complementario para el cual fue diseñado es una necesidad también muy relevante para poder preservar y mitigar la vulnerabilidad financiera a la que se podrían ver expuestas las personas en esta etapa en caso de que hagan un uso prematuro de los recursos. Y por otro lado, también es necesario poder desarrollar, ojalá pronto, una solución que le permita dar esta estabilidad en los ingresos mensuales a las personas que ya están en su etapa de pensión, pero al mismo tiempo que mitiguen el riesgo de longevidad, porque como lo hemos visto con el incremento en la expectativa de vida de las personas, en la medida en la que estos recursos vayan a ser necesarios por varias décadas después de que las personas se pensionen, pues también constituye un desafío a la hora de administrarlas para asegurar que las personas en su etapa de jubilación no se vean en una condición de vulnerabilidad financiera.
Muchísimas gracias, Ana María. Ha sido muy interesante. Hay todo un reto y obviamente esta modalidad de pensiones que tenemos en los países, Perú en particular tiene también esta modalidad de retiro programado, ofrece sin duda un reto para satisfacer las expectativas de los trabajadores que pasan a jubilarse o que aspiran a un retiro y a una protección para la vejez. Como segundo panelista, permítame presentarle a Francesco Briganti, quien es secretario general de Cross Border Benefits Alliance Europe. Es una destacada asociación que incluye y abarca fondos de pensiones, compañías de seguros, gestores de activos, administradores de pensiones, bufet de abogados y otras asociaciones tanto nacionales como internacionales y opera en Europa. El señor Briganti es licenciado en Derecho por la Universidad de Bolonia, Italia. Tiene un máster en Economía Política Internacional por la Universidad de Kent, en Reino Unido, y un doctorado en Derecho por la Unión Europea por la Fundación Universitaria Marco Biaggi de Modena, en Italia, donde sus estudios y dedicó tiempo a la creación de un plan de pensiones de empleo que abarque a toda Europa. Francesco Briganti nos va a exponer acerca de los productos de jubilación en Europa, y a quien invito a que nos haga la presentación. Francesco, por favor.
Muchas gracias. Haré esta presentación en inglés para los que no hablan español. Y, entonces voy a empezar, and I will start then with first of all an introduction about the systems, the pension system in Europe. There are basically two big phases of our pension systems. So probably for you it's quite familiar to see that there is a first pillar and we have then a second and third pillar. But the big point here to make a difference with several Latin American, I would say all the Latin American countries, is that the second pillar in Europe is not considered, it is considered as a product that is offered by companies. So we call it occupational pensions or workplace pensions. So basically the companies offered these retirement products to their employees. Now, what it is important is that in many countries, the second pillar is voluntary. In few countries, it is mandatory or quasi-mandatory, but in the great majority of the European countries, the second pillar is voluntary. And of course, it is offered not only necessarily by one company. Sometimes we have sector-wide, in many countries of Europe, we have sector-wide occupational pensions, which means that the companies, together with the unions, with the trade unions, they make collective agreements, and they set up their occupational pension funds for each sector, meaning that there are several, those and even hundreds of companies contributing to these pension funds and workers as well. The third pillar instead is individual, voluntary, managed by insurance companies, banks, asset managers, and so on. For us, in a European perspective, it is also important to underline that the second and the third pillar are supervised by the European authority, which is called EIOPA, European Insurance and Occupational Pensions Authority, and the second and third pillar are also subject to the European competition laws. So basically, they are regulated in great part by the European Union legislation, which is not the case for the first pillar, which basically is still under the competence of the member states. It's important because then when we will see later some possible, let's say, formulas, we have to make this difference between the first pillar under the state and the other ones. There is another important issue, which is instead the change of, in many countries, of the first pillar, and I'm trying to change without success my slide, and it's the fact that in, I would say from the end of the 90s and the beginning of the 20s, of course 2000, in some countries, especially in the Central and Eastern European countries, the first pillar, which was in the past pay-as-you-go, and it is still pay-as-you-go in the great majority of the European countries, where it was split into two parts, following, let's say, the World Bank model. And you can see that the same statutory contributions, or at least part of them, were diverted to pension providers, and these pension providers, yes, were working on a funded basis. I would guess that you would call here in Latin America this, the gray part, as your second pillar. For us, it is still a first pillar bis. We call it first pillar bis because it is still under responsibility of the state. Of course, from a European Union perspective. It's from a European, because, for example, of course, in these countries, they call them as well, they call it second pillar. But actually, from a European perspective, it is still under the state responsibility because they are legal contributions, so they are established by the state, and they are part of the overall social security system. Second pillar remains, of course. In some countries, it is more developed, in some others, it is not. Maybe the last thing you should know about this first pillar bis is that also in the so-called Nordic countries, so Scandinavian countries like Sweden or Denmark, those countries have an additional pension fund which is funded, but it is still part of their social security system. So it is mandatory, funded, but it is not considered as a second pillar. It is a first pillar bis. It's complicated. You have to understand that we have 27 member states in the EU, and the pension systems are very different, are still very different. Okay, then just here to tell you something that is fundamental for this presentation is the fact, if you look at these first two columns, the first pillar, and you see the contributions, the first pillar, so the statutory state pension, mainly pay-as-you-go, like I said, in many countries, the contributions are very, very high because you know the situation of our demography. And you know that also in Europe, pensions have been very generous in the last years. So you can see that basically, especially in the most populated country of the European Union, Germany, France, Italy, Spain, very easily you can reach more than 20% of your contribution to a first pillar, which is still pay-as-you-go. So imagine that, for example, in France, they arrive to 27% of their salary. In Italy, we are the best. 33% of the contributions to the pay-as-you-go pillar. So you can imagine that with that, there is not a big room for funded pensions on the top of the existing pay-as-you-go, when they are so big, so large, and so expensive. But at the same time, you also know that the aging population, which is a problem everywhere, but in Europe is even more dramatic. And so that's the reason why, despite of the fact that if you see the ratio between funded and non-funded pensions, you can see that some European countries are on the top, but maybe with the great exception of the Netherlands. But these countries are not really populated. So you see a huge funded part of the pension system, but let's say the countries that are really very much populated in Europe, look at these ones, you see that the funded part is still really, really small. And that's the problem. Now, when we go to look at a little bit this products or formulas for the payout, keeping this in mind, all this, let's say, potential flexibility is applied to this small part of the funded pensions, because the rest is still going on a pay-as-you-go basis. Okay. So now, some examples. I think you are quite familiar with some of them, and then anyway, I know that Pablo will explain much more in depth this kind of potential variables. But I can tell you, in Britain, for example, they introduced in 2015 the possibility to have a payout with program withdrawals, which means that the users, so the members of pension funds, when they reach the retirement age, they can establish different withdrawals in terms of quantity of money and frequency of their withdrawals. So it's something that is different from the typical traditional annuities or lump sums. Maybe one thing I forgot, but I'm sure you know, also in Europe, we are all going to a defined contribution system, even though the existing pension funds are still, because of the pre-existent members, the assets are still larger in the defined benefits. But of course, the process is ongoing, and in a few years, the defined contribution will prevail at all, completely. Variable annuities. This is something that happens in Sweden. This is, for example, this happens in the so-called first pillar Bs. Sweden and Denmark have a system where, in Sweden, they call it the premium pension. It's a small funded part of the first pillar. And people, when retire, they can decide to have a variable option. This variable payout means that if the financial markets go well, they still keep investing, they will get more money, but if instead the financial markets do not go well, they will have a reduction of their pension benefits. In Denmark, the pension fund, which is called ATP, again, it is managed by social partners, employers and employees, but it is owned by the state. This system instead does not go down with the annuities, so the money they receive people are always, but can be increased if the financial markets go well. So it's another form of flexibility. The guaranteed period annuities and hybrid options is something that is existing a little bit in Germany, and they are discussing in France. It's a way where people, when they retire, they can decide to have an annuities for a period of time that they decide. For example, they say, give me for 30 years, they decide the time, they have the same amount of, and in such a case, in case they live less, so they die basically, the money will go to their heirs. It's a way of having this guaranteed long-term annuities. In France, there are some hybrid options where you can take, in Italy as well, to be honest, you can get a part of lump sum immediately, and then you can have annuities for the rest of the capital that remained. About the fourth option, longevity in pooling solutions, this is something that is about, I heard about today, solidarity in pension funds. This is a typical example of solidarity, because in these longevity pooling solutions, basically we have collective risk sharing of the pension capitals. And so what happens is that, for example, in the Netherlands in particular, the collective defined contribution systems, when the pensions are going to be paid, the money of the pension funds are pooled in one big fund. And so, of course, when people die, in this collective pool, the others the system will help to mitigate the risks, because this money will go to these people who will survive more. So it's a really way to pool this money, and the same happens in Denmark with the ATP pension fund. Deferred annuities. This is something that, to be honest, it is more in the United States, but there are some discussions in Europe about this. And the idea here is that you decide, when you reach your retirement age, you decide to start getting your annuities from an age that you decide. For example, I am still quite wealthy. I reach the retirement age. I decide that from when I will be 80 onwards, from the 80 years old onwards, I will start receiving annuities. And so this is it's the reason why it is called deferred, right? You decide later, and this is, of course, to protect yourself for the moment when we will get very old. The last flexible pension options, it's quite easy, of course, and again, is a mix where you can get a first lump sum, and then you have a choice. It happens in the UK and in Sweden, and then you decide with the rest of your capital, or to do some other withdrawals during some specific times of your retirement period, or to start having annuities. So it's another flexible way to manage this. Again, like I said before, this is very important also to understand the overall situation of the financial situation of the pensioner. But most of all, like I said before, these options are very interesting, but still represent a small part of the pension income of the Europeans. So I think this is my personal idea, maybe we will discuss later. Yes, we can have a lot of fantasy and creativity, but the reality is that this does not really change the pension situation of the people, because the amount coming from funded pensions is still very little, apart from countries, for example, the Netherlands, where more than 50% of the pension income is from funded pensions. But there are really few exceptions in Europe. Okay, and then maybe I will finish food for thoughts for later, if we can, because when we talk about innovation, when we talk about possible solutions, it was very interesting today to listen these examples from different parts of the world. It's difficult to have a real one-fits-for-all solution, because there are many differences, especially, for example, if I look at the first point, expectation that and the culture that in a given country or region of the world people have from pension systems. In Europe, we do expect a lot of money from pensions because we are being used like this. So I would say that we are quite spoiled. The problem is that the situation has completely changed. But when we see what our parents or grandparents were getting from the pension systems, we still think that everything should continue this way, and it is not the case at all. So, you know, this is one, the culture. The second, of course, is the demographic trend. But I understood today that in Latin America, situation is not going to be better, but basically you are really becoming like us, and also it was very interesting to hear the presentation about the low fertility and all these problems of aging in the entire world, so it's a big issue. And so here again, pay as you go, maybe it's not anymore the good solution. We have to find new ways. Investment mindset and financial literacy, this is fundamental because, of course, people who are not familiar with investments, in Europe we are not very much, in general, of course. People don't like risk. They are very skeptical about investments, so they don't really rely on financial markets. And we can see, especially in the countries where pension funds are not really developed, that the returns on the investments are very low. And they are very low because they are very conservative. And that's what people want. But honestly, they are so low that maybe it is not really worth it to have a pension fund when your returns are a little bit, almost comparable with your bank account, maybe a little bit more. They didn't get the point, but of course they don't like the risk. And especially when they make decisions, and they can, in some jurisdictions, they can make decisions about their investments, they always choose the conservative. And so this is a big issue as well. Then again, solidarity, collectivity, risk sharing. It's funny because when I say solidarity and I make a presentation in the United States, they told me, Francesco, don't say solidarity because for us solidarity sounds communism. So you don't say solidarity, you have to say risk sharing or collective, okay? But it's the same concept, of course, like they do in the Netherlands, in Denmark, in the Nordic countries. So to pool the money. Labor market, I think it was something that we understood very, very well. Not only the collective agreements. If you have collective agreements, they can be mandatory, you can extend, you can cover more population, but also labor market means gray economy or not. Also independent workers, sometimes independent workers are not covered by those pension funds that they are based on the assumption that there is always an employee, an employer, but we know that the economy and the labor markets are changing very, very fast, and it's not anymore. And so there is an issue of coverage of this in Europe as well. And then, well, nationalization of pension funds. We did have nationalization of pension funds, but again, when you remember this first pillar and first pillar bis, it's something that we discussed before. The nationalization happened for the first pillar bis, because the first pillar bis was still considered by the European Union as a part of the statutory public system. So nationalization was possible, and the European Union didn't say anything because it was still considered as a part of the national social security system, even though it was outsourced, of course, to pension managers and making investments, but still. It would be much more difficult to nationalize the occupational pensions because those, yes, are protected by the European legislation. Like as a lawyer, I'm saying that it's quite different. And then, well, new, and like I said before, I think new innovative forms of payment might be useful. We will discuss it later, I guess. But then we also to consider many other factors and the individual capacity, the overall system. I would say that, to be honest, in my opinion, in Europe, I'm talking about the European perspective, instead of speaking about products or tools, we should speak about formulas of our pension system. I think that the real challenge for us is not to change some flexibility in the payout and so on. Of course, it could be okay. But the real problem for us is the huge size of the pay-as-you-go systems from which we are not able to get out. And so they are so expensive and it's very difficult to develop the funded part. So this is, in my opinion, not only, of course, mine, but I mean, there's a big discussion in Europe about this. And I finish with another topic that for us now is more and more important. We realized a few years ago that why not? Funded pensions generate huge capitals, might generate huge capitals. And huge capitals can be used to invest in the real economy. And this is something that, of course, also EIOPA is, we have an initiative which is called the Capital Markets Union. So we would like to use also the money of the pension funds to make investments in the real economy, to integrate the markets, and to basically try to replace a little bit the funding from the state, taxpayers, and the funding from the banks, because today companies in Europe still depend, I would say 90%, 80% from banking, from bank loans, or infrastructure are made by the state. But we see experiences in Canada, in Australia, in the different ways of funding, but this money of the pension funds is also used to create infrastructure and to fund startups, innovation, and so on. It's something that in Europe is lacking. We relied a lot on the old, let's say, old-style system. Okay, I think I would finish here for the moment. and I will leave the floor to my friend and godfather, Pablo Antolin.
Muchas gracias, Francesco. Una interesante perspectiva desde países de la Unión Europea, que sin duda tienen una variedad muy amplia y también algunos retos importantes. Nuestro último panelista, no por ello menos importante, por supuesto, es Pablo Antolin, a quien todos conocemos, pero igual voy a presentarlo. Es licenciado en Economía por la Universidad de Alicante y doctor en Economía por la Universidad de Oxford. Actualmente es jefe de pensiones y seguros de la OECD en la Dirección de Asuntos Financieros y Empresariales. Sin duda nos va a presentar una visión bastante amplia desde la perspectiva de la OECD. Por favor, Pablo.
Gracias. Gracias, Elio. Buenas tardes a todo el mundo. Como ha dicho Elio, tengo el placer de ser la última persona que va a presentar hoy, entonces os ruego que bear with me, as we say in English. Before I start my presentation, I would like to thank you for being here, obviously, and for being here in the last presentation, and for giving me the opportunity, therefore, to present the OECD view about instruments. Thank you. Instruments to provide retirement income. I'm following here from Francesco because we don't like to call it products at the OECD. A product is something that the private sector produces, but what we are really talking is about instrument. A program withdrawal is not a product. So at least in our terminology. So why is this important? Well, this is a very essential issue, how you design the payout phase, how you provide instruments to provide retirement income. Because the essence of a pension system is to provide income when people retire until they pass away, meaning that you are protecting people from longevity risk. You are protecting people from running out of money when they are retired. From the point of view of the OECD, this is essential because this is the purpose of a pension system. This is why you develop a pension system that people accumulate rights or assets in a pay-as-you-go system or in an asset-backed pension system to finance retirement. So this is essential for us, and protection from longevity is everything. So the main message of my presentation today is this one. We have a choice of instruments to provide retirement income, and I'm going to focus on defined contribution pension plans. I'm not going to talk about public, pay-as-you-go, or defined benefit pension plans. I'm focusing on defined contributions. And the message is the choice that you regulators, supervisors, and policymakers are going to make depends or needs to account for how defined contribution pension plans fit in the overall pension system. We saw the presentation by Francesco that in Europe you have a very strong pay-as-you-go public system. We hear this in the session before that in Indonesia you have a combination. We have here in Costa Rica that you also have different elements, and we have here from all other countries that there is a variety of pension systems. So the choice of instruments to provide retirement income needs to account for all of this. But the most important point is what I said before. It needs to make sure that everybody who retires is protected against longevity risk, will have income until from the time they retire until the time they pass away. In order to elaborate that, the structure of my talk is going to be based on 3 points. The main question I am addressing, obviously, from where I just say, you can guess, what are the best suited instruments to provide for retirement income? We already hear Europe, Costa Rica, and also Indonesia. We heard this previously, the type of instruments they have. And in order to answer these questions, I'm going to have 3 parts in my presentation. And quickly, first, obviously, as an OECD, I will present the OECD recommendation for the good design, because this is the framework that establishes what we say. This framework is not something that we, workers or staff at the OECD, have invented or come up with. In the OECD, regulators, supervisors from OECD countries, and also many times from non-OECD countries, our colleagues from the IOPS also participate. We develop or share experiences of what works, what doesn't work, under what conditions, and the starting point in the different countries is essential, and we come up with good practices. We don't have one way of doing things, we have many ways of doing things, and depending on the objectives, that's the way. The second part is going to be, I will talk very little, probably I will not have time, but because the title of the session talks about what is the impact of demographic realities. We have heard a lot about it today, but from our point of view, the impact is different whether you have a pay-as-you-go, whether you have a promise, or whether you have a defined contribution. And it's very important to have in mind these differences when you look at the different instruments. And finally, I'm going to talk about the instruments. Traditional instruments, we have heard about lump sums, we have heard about drawdowns or program withdrawals, as they are called here in Latin America, and we have heard about life annuity, but also Francesco introduced new approaches that they are implemented in Europe, in the US in particular. He talked about longevity, how you call it? I wrote it down because you call it longevity. Poolings, but we call it at the OECD non-guaranteed lifetime income. It's much more complicated, but it's because it's not just pooling longevity. You can also pool investment and everything. I will talk about home equity. I will talk a lot about that, and potential combinations of all of that. Because some of the flexibility that Francesco was talking about in European countries, which also happens in other OECD countries like Japan and United States and Canada, the flexibility is introduced by combining different type of instruments. So quickly, what's the recommendation for the good design says on that? Well, basically, we have number 7, which says that any pension system should ensure that people is protected against longevity risk in retirement. That is essential for us, and this is the starting point to evaluate any option, any instrument to provide retirement income. But also there is an element that we like to talk about at the OECD, which is essential. If you're going to, and some people mentioned this morning or early this afternoon, we don't know what is going to be our life expectancy. It's uncertain, but we can model it. And that's why we have to facilitate the regular monitoring and management of longevity risk. And this is related to mortality tables. And how do we do that? Well, in the OECD Pensions Outlook 3 years ago, Chapter 4, we have good practices for developing a standard mortality table for retirement income arrangements. Again, we come up with all of that looking at the experiences of different countries. And basically what it says is you need to use appropriate tables, meaning you should make the tables using the relevant population. In some countries, the relevant population, because the design of the system is the entire working population. In other countries, only is a subgroup. For example, Francesco was saying that in many European countries, it's a subgroup of the population because it doesn't, the asset-backed pension system, defined contribution, do not cover everybody. In other countries, it covers everybody. You also need to update these assumptions regularly. Some countries didn't do it. 10 years pass by, 20 years pass by, and suddenly, if they have a promise, they realize that people is living on average at 65, 2 to 3 years more than they calculated, where all this money is going to come from. And it's also important that the mortality tables incorporate future improvements. At the end of the day, we don't know how life expectancy is going to be, how much we are going to live, but we can model it. And if we model it, we can account for it, we can reserve for it, and we can prepare for it. And the only thing that is left is the difference between what it will be the reality at the end of the day and what we have modeled. But the best we model, the closer we are and the less unknowns we have. And this is very important. Let me move to the first point. It comes from the OECD recommendation. Ensure protection from longevity risk in retirement. And this leads us directly to the issue of this session today. What type of instruments do we have to provide retirement income? The first point, and this linked to what I have said before, but Francesco was highlighting, is we need to make sure that when we choose instruments, we meaning policymakers, regulators, supervisors, we take into account the pension system, the overall pension system. Because, as we hear in Europe, the pay-as-you-go pension system already provides for longevity. The public pension provides for longevity risk. If an Italian pays 33% and it gets a 70% replacement rate, meaning that it gets 70% of their final salary, they are already protected from longevity risk. If you have a strong universal pension that is very high, like the Australians or the Chileans right now, well, you already have a large portion of the population already protected from longevity risk. And this is important because the type of instruments that you are going to choose will have to take these things into account. The choice depends on the desirable balance between the cost of guarantees and the stability of retirement income. You were also talking in Costa Rica about the stability of retirement income. You have to, as you say, we need to balance and this is one of the key messages. And Francesco was talking about the Europeans love guarantees, they don't like risk. Well, yes, fine, that's a choice. It costs money. So you need to reach a balance between those two things. There is no right or wrong. There is an acknowledgement of the potential implication of the choices and the cost. And of course, you also need to balance flexibility and protection. And I will talk a little bit more about that. So on the role of the DC pension plan, given the time, I'm already used half of my time, it's very important to understand how much people need in retirement, and it's also need to the proportion that comes from asset-backed pensions. And also that you have basic needs, you have security to address unexpected spending, and you also have lifestyle discretionary spending. Many people might not reach that point, but when you design, you need to take into account that the basic needs to be covered. This is essential in any pension system. Then, of course, unexpected and security. So, again, the message here is how you choose the instruments to provide for retirement income depends on how the defined contribution pension system fits in the overall picture. On the demographic challenges, let me just put out everything instead of going one by one because we don't have much time. Well, we hear this morning about fertility. We also hear about people living longer. All of that, what it does is that the average age of the population keeps increasing. People stay longer in retirement, and the cohorts entering the labor market become smaller and smaller. Population aging has an impact on pay-as-you-go, on defined benefits, on defined contribution, on asset-backed pensions. But the transmission mechanism is different. And this is important because the type of instruments that you are going to establish is going to depend on all these kind of issues. On the mechanism of transition of the population aging. In pay-as-you-go, obviously, we already hear the main problem and also the main problems on defined contribution system is that if you don't take that into account, you are going to accumulate an amount of money that must finance a longer period in retirement that you plan for. And the mortality tables, and that's why I introduced the mortality tables, is quite important. So when there is a promise, you have a fiscal or a financial problem. When people save in defined contribution, you have an adequacy problem. And how aging works through, it depends whether it's a pay-as-you-go or it's asset-backed. If it's asset-backed, it works through productivity and GDP growth and, in turn, through returns. So what are the instruments that we have taken into account? Well, my previous speakers already introduced all of them. I'm just going to quickly highlight from the point of view of the OECD main messages that I put forward, number 7, number 8, but in particular number 7, provide protection from longevity risk and take into account that whatever instrument you decide, you need to take the overall pension system in place. Well, first, lump sums. Most countries provide lump sums. In Asia, we hear in Indonesia, we hear here. In most countries, in Central and Eastern Europe also at the beginning, the option was a lump sum. So we have a whole system to accumulate assets, then people took it away. That's fine if we have a strong pay-as-you-go public system that protects from longevity risk. But in some sense, it just become a tax favor retirement saving, tax favor saving, long-term saving plan. It's not income. So it does not provide a pension and it does not provide protection from longevity risk. So the main message of the OECD in that famous number 7 recommendation is lump sum should be discouraged in general. Obviously, there are special circumstances and special situations in which it should be allowed, but you need to define it in the legislation, take into account the overall pension system. Annuities. Well, annuities provide protection from longevity risk because you get a stream of income from the day you buy the annuity, if it's the day you retire, until the day you pass away. But we can have different type of annuities. We can have with guarantee payments or non-guarantee arrangements where longevity risk is pooled among participants that can provide lifetime income. The key point here is all those instruments, whether they are fixed or not, they provide protection from longevity risk. Life annuity, immediate life annuity, provide protection from longevity risk, but they are not flexible. If you have to pay down debt, if you have some extra problems that you need money for, well, you will have to reduce it from your monthly payment of the annuity that you get. The provider, normally insurance companies, are the ones assuming the longevity risk. The longevity risk doesn't disappear. It's just shifted to, theoretically, an institution that probably manages better than an individual by itself. And it pulls all the risk of all the annuitants that buy annuities with them. Then you have mortality table, reserves, and supervision, and your supervisors know that much better than me. Then they talk about life annuity with guarantees. Well, basically what they do, there in many countries they have introduced this. You can have a life annuity. People like to think if they're going to die 5, 10, or 15 years before, after they buy the annuity, their heirs will be able to inherit the money. That's fine. It costs money. But it exists and it's there. But it costs money. If you choose that, just be aware that it costs money. It's not wrong or right. It's very important, and it exists in many countries now. Deferred annuities. Deferred annuities, I will talk in shortly, that is a good idea. It's been experiences in many, they call it longevity insurance in some countries like the US and in Chile. But of course, it brings higher risk for providers because providers have to make a promise at the time you buy the annuity that will start paying 10, 20, 30 years later. And they need instruments to hedge that risk. And we have been hearing today that even pension funds are not allowed to invest or to have instruments to hedge in their normal functioning during the accumulation phase. Imagine afterwards. And there is also the non-guaranteed lifetime income products. Chapter 5 in the Pensions Outlook 2022 provide policy lessons on the design, introduction, and implementation. Obviously, these are good solutions. because in systems where you already have longevity protection through the pay-as-you-go system, all this allows you for flexibility. They produce higher expected income than individual drawdowns because you are pooling risk, as Francesco said, but the benefits are volatile because many times you also not only pool longevity risk, which makes the benefits volatile, but also you're pooling investment risk. So benefits are volatile. If the population does not accept or are not told that this is the case, they might be against it. So they need to do. Obviously, it allows the providers of this type of products, we don't need to be insurance companies, they can be pension funds. It allows them to invest in higher growth assets. This is one of the things that the Danish do. He was talking that in Denmark, it never goes down. In Denmark, they have a guarantee for a certain level, and the rest is invested in higher growth assets. And if it goes higher up, it's distributed, and they get a higher pension. Drawdowns, program withdrawal, no protection from longevity risk. They provide flexibility, but there is no protection from longevity risk. We, in the Pension Outlook we published in last December, we talk about equity release products. This is something that is being developed in many countries. We can talk a lot and I can tell you, but we don't have much time. And the last message is that combination, partial, defer, or delay lifetime income combined with program withdrawal is the best way of having flexibility and also protection from longevity risk. And for systems that are trying to reach this kind of balance or strike a balance between flexibility, because flexibility is important, and also protection from longevity risk, which from us, the OECD, is the essence of a pension system, the overall pension system, obviously, taking into account the overall. This is a good solution that we think people should consider. Obviously, the fair life annuity, not easy. Insurance companies might have problems with it, but there are ways out of it, and it's been developed in many countries. So it's program withdrawal with the fair life annuity that they are bought at the time of retirement and start paying you, let's say, 20 years down the road. 20 years, why? Because it's the average life expectancy at 65 in many countries. So to finalize, the main messages that I hope you will take with you today are the following. First, that all retirees and the choice of instruments to provide retirement income should be based on the fact that all retirees should be protected from longevity risk. This is essential. Also, the choice of the different instruments I presented and my colleagues also presented depend on the overall pension system, how the defined contribution pension system fits in the overall pension system. And lump sums should be discouraged, except in exceptional circumstances. And combining program withdrawal with the fair life annuities will or would achieve most policies objectives from our point of view. And program withdrawal with the fair life annuity, call it longevity insurance, this gives flexibility, higher income, and protection from longevity risk. Thank you very much.
Muchas gracias a nuestros tres panelistas, sin duda puntos de vista muy enriquecedores. Si hubiera alguna pregunta del público, ¿no tiene?
¿Quiere irse de vacaciones?
Si hubiera alguna pregunta, por favor. Yo sé que estamos en la hora avanzada, pero igual creo que tenemos espacio para algunos temas. temas. Por favor.
Sí, buenas tardes. Tal vez para Ana María Brenes y los demás participantes. Digamos, en el caso de nuestro país, ¿a qué se debe la alta volatilidad en los rendimientos de los fondos? Porque eso genera inestabilidad y hasta desconfianza en los fondos, ¿verdad? Y nos, digamos, un poco para saber si es productos, no sé, estructurales de la economía o de las opciones de inversión. Esa es una. Y la otra es qué opciones se generan para los fondos voluntarios.
La volatilidad está asociada al comportamiento de las condiciones de mercado y usualmente la volatilidad se presenta más en periodos cortos de tiempo y el efecto de la volatilidad de esa volatilidad de periodos cortos de tiempo se va diluyendo a medida que vamos analizando periodos más largos de tiempo. Es importante aquí cuando hablamos de pensiones, el horizonte de tiempo suelen ser varias décadas y como lo hemos conversado incluso en el periodo de retiro, una persona aquí se jubila a los 65 años, puede tener delante incluso varias décadas de horizonte de tiempo durante el cual va a requerir esos recursos. Entonces, al hablar de un horizonte largo de tiempo, la volatilidad que se registra usualmente en el corto plazo, que se asocia a variaciones como aumentos o disminuciones en las tasas de interés, variaciones en los tipos de cambio, diferentes circunstancias que pueden hacer variar los precios de mercado de las inversiones, esas variaciones se observan más en periodos cortos de tiempo y esa volatilidad se va diluyendo, va perdiendo importancia a medida que analizamos horizontes más largos de tiempo. La pregunta, perdón. La opción para los planes voluntarios, hasta el momento lo que existe es el retiro total, que es posible a partir de los 57 años de edad. Igualmente, existe la posibilidad de hacer aportes extraordinarios en el ROP, de forma tal que la persona puede robustecer el monto que recibe de los planes de beneficios que recibe actualmente del ROP. Entonces, quizá para los planes voluntarios existe ambas alternativas, o el retiro total, o utilizar ese monto como un aporte extraordinario para robustecer el monto que tiene en el ROP a partir del cual se calcula el monto mensual que está recibiendo de pensión.
Okay, thank you to all the speakers. Thank you for the wonderful presentation. So my question is to the OECD rep in terms of program withdrawals. I think at some point I got a bit confused because I think I was reading on the slide that you said program withdrawals should have some form of life income. And I wanted to ask later that if that's the case, is that not dabbling into annuity? But towards the end of your presentation, of course, you did clarify that program withdrawal doesn't offer protection against longevity risk. My question is, if program withdrawal doesn't offer protection against longevity risk, and you have life annuity, guaranteed life annuity that offers that protection, why then should anyone choose program withdrawal? Why not just go for the guaranteed life annuity? Even though I also note that, I mean, you said the best is a combination of deferred annuity and program withdrawal. But I would think that if guaranteed life annuity can give me what I want, why do you need the mix of both? That's one. Then number two, and I'm from Nigeria, by the way. So from what I've seen, the insurance companies in Nigeria offering annuity products are able to provide higher returns than those under program withdrawals. I don't know if across other jurisdictions you see that as well. It's beginning to look to me like the annuity product is more superior than program withdrawal because of the sheer fact it offers a lot more returns than program withdrawals offers? Thank you.
Thank you very much for those questions. I don't know how to start answering because I do believe that life annuity are a superior product because it provides you from protection from longevity risk. But the fact is most people don't like life annuities, don't choose life annuities. And the arguments basically are based on the fact that, as I mentioned here, they don't provide you with flexibility. You accumulate a large amount of money, you give it to an insurance company the day you retire, and that's it. And you get the payment that is determined by the annuity premium. Also, there is the issue, a lot of people believe that is inheritance. A lot of people want to be able, if they pass away, to give the money they have accumulated in their working life into, to give it to their partners or children, to give it as an inheritance. And that seems to be a strong reason. In some jurisdictions, they also argue that people love and think they are better managing their own money than insurance companies or pension funds that continue providing, and they can make choices. All those reasons are normally put forward to argue against life annuities. Program withdrawals, the only problem they have is they allow for all the other things, but they don't provide you for longevity risk. There is another argument not to go for life annuity. A lot of people believe they are going to live less than they actually live, so they don't want the insurance company to keep up with that money, because it's their money. But the reality is people live longer. The second part of the question was about life annuity being moved across different jurisdictions and borders. Is that what you meant?
I said that in Nigeria, what I've noticed is life annuity offers higher returns than program withdrawals. So I was like, I mean, based on what you've seen from other jurisdictions, is that the same as well?
In general, if a program withdrawal is properly invested by the pension fund, it might get higher return because a life annuity will invest, well, let's put it in the following way. The way an insurance company will calculate your life annuity will be based on the risk-free rate of return, which basically is 10-year government bonds or the term structure of government bonds. That is always going to be, in general, in financing and in many areas of pensions, everything is about probability, but with a high probability, if you invest, and that related to the question they asked you, in equities and other type of instrument, they will always provide over a long period of time, and numbers show that in every country, a higher rate of return. But if the program withdrawal is invested in a very conservative type of portfolio, then the numbers that you mentioned will occur, I will say. So, but in general, life annuity will provide a lower. Another thing is what the insurance company does with that pool of money and invest it. Because depending on the regulation, they have to reserve, meaning investing in secure, liquid assets, but they also can have a proportion that will invest in growth assets and get a higher return, which at the end of the day is part of the benefits they will get for managing that pot of money and for promising you to pay a regular stream of income during your entire life in retirement.
Okay, thank you.
Yes, please.
Okay, I just want to add to what she has said. I'm from Nigeria too. In Nigeria, we have what we call pension protection fund under the program withdrawal. So it means that even if your money has been exhausted, the pension fund administrator will have to provide you the minimum pension guarantee up to your date of death. However, in the insurance, I think what she is trying to say, they offer more in terms of the annuity they are going to collect because of the returns that they get from the investment because it's in the pool. That's what they do in the Nigerian market. So I think the most important thing is even in the pension, in the program withdrawal, it still provide a minimum pension for you, even if your balance has been exhausted, using the pension protection fund, which the government provided. Thank you.
Happy to discuss later on, because the first thing I'm going to ask you is you to explain me a few features of the Nigerian system to be able to answer the question. So we can talk afterwards if you want.
Thank you. I have a question for Francesco, please. Francesco, you presented a very interesting perspective from European countries. You mentioned something interesting, that the most important challenge for European countries is not the kind of type of products, retirement products, but the most important challenge is the structure of your pension systems, because there are some countries that have a very high payout pillar with a small defined contribution pillar. So, and this is a challenge. So my question is, how could be a solution? How can we, do you think it could be promoted to implement a more strong second pillar or defined contribution pillar, for example?
Thank you. It's a very difficult question because, like I said, the contributions to the first pillar are very, very high. And of course, you can imagine that there is not much room to add. Of course, there is somehow, but to add additional contributions to a funded pillar would mean also to raise the cost of labor, which is already very high in Europe. And so the competitiveness of the country would be, of our countries would be completely diminished. Of course, the pay-as-you-go is not going very far away. I would say that instead of pay-as-you-go, today in Europe we should say pray-as-you-go, because I mean, come on, if we continue this way, if you look at the figures, we still need to raise the contributions, but there are not any more active people, and even migration is not. So it's a long story, but I mean, to make the story short, in my opinion, and we should cut somehow the costs of the first pillar and to divert part of this money, especially for the young generations. The young generations should start to divert part of their contributions to the pay-as-you-go and to start paying into funded systems. Of course, should be a very gradual process, but should be done in a way or another. It's very sensitive, it's very difficult, but we have a real problem of generational problem. If you just think, and just close, my mother, Mamma Mia, she started her pension when she was 39. Pay as you go, 39. She's still wealthy, she's still healthy, alive, and fantastic. But you can imagine that she's now 82, and she's still getting a pension. And you can imagine that this is not a system that cannot work anymore.
Thank you. Unfortunately, the time is over. No tenemos mucho más tiempo. Yo particularmente tengo algunas preguntas adicionales que las haré luego, por supuesto. Así que, y estando con el tiempo en contra, no me queda más por dar culminada esta sesión, sin antes pedirle al público que le brindemos un fuerte aplauso a nuestros panelistas.